Hello, everyone. My name is Guillaume Prou. I'm VP of Technology here at Beta Virtual Assistants. So we're hosting one of our Thursday tax tips with Beta Virtual Assistants. So let me check if actually the audio is working fine, just to make sure. So today, actually, let's see if that works. Let's see. Seems to be working. All right. So let's go ahead. So what I wanted to talk to you today is the topic of the day is how do we handle like taxes? What are the tax implication of having like holding, or what some people call in the crypto world hodling, and maybe some other things like staking and interest bearing account. So basically, when you're when you're holding for when you're holding some coins or crypto, often people just buy either a one-time amount, or they buy like they use like some other method, like let's say DCA, dollar cost averaging, where they're just buying on a regular basis. And usually they hope that the crypto will basically go up in value over time, like either in the short term or longer term. So they just hold on to their coins. And there was a history of someone who just misspelled it back then, hodl, and so old became hodl, and so that's why people call this hodl or hodling. So the fact that you're basically just buying and not selling right away and just hodling or hodling for the long term, there's a couple implication to that. So one is that when you want to trigger tax event, normally you trigger tax event because you're either selling your coins or you're converting them to a different um, just converting them from one coin to another. So that's usually considered like a sell and a buy. So then that triggers a tax event. So if you're just buying and not selling, so that probably doesn't trigger a tax event in most cases. So one advantage is if you it just goes up in value, then basically you can still kind of keep the profit without paying taxes, because until you sell it, then you're not basically doesn't have to report taxes, and you may not have to pay taxes on your gains. And then the one advantage is then when you actually sell and report this, in most cases, in most countries, it's probably going to be considered like investing. And so it's probably going to be considered capital gains also, which usually is more tax advantageous. The other actually implication is that because you're holding for a certain time, in some instance, like in the USA, you might be qualified for the long-term capital gain, which is usually if you hold over a year. So that if you have good records and you just have accounts where you're just holding and investing basically on the long term, so you might pay probably less. It might consider capital gain. It might be maybe long-term capital gain, and maybe you won't need to pay taxes frequently or regularly, because you only will be able have to pay taxes when you're going to sell at some point in time. So those are advantages mostly. So the only one disadvantage is, of course, if the value goes down and doesn't go up, and then so you might actually have a paper loss until you sell, or you have a paper loss until it goes back up, or if you decide to sell at some point, then it might trigger a capital loss. But that's a good way to look at it. On the other hand, if you're using another method where it might be more like you want there's a bunch of either exchanges or certain protocol, or even certain kind of more like savings account, where in fact you store your coin, but you kind of put them aside for either a fixed period of time or sometimes not, but basically you say, I want to put them in like a savings account of some sort. Some call this kind of an interest bearing account, or sometimes that's called more like staking, where basically you move your coins to another place where, because they have access to your coin somehow in most cases, then they will give you back some kind of interest on a regular basis. Could be daily, weekly, or something like that. Sometimes if you put them for longer term, a month or 3 months, you might even get more interest. So the point is that this creates like liquidity, and one disadvantage is actually it might you have to be careful, because they might be, what if they're using this because you're not holding them anymore, so that there might be other issue like scam or hack or people disappearing with your coins. So that's a different issue. But what on the tax consideration is that you're gonna be collecting probably interest on a regular basis. So that means a few things. One is probably you will get that frequently, and so that will trigger tax events. So every time you're getting interest, that's probably going to be considered income, and so not capital gain, but it's going to be considered income, which is basically usually tax based on your tax bracket. So you won't probably qualify for capital gain. So that will be considered income. And then also because it's short term anyway, it's not gonna be the most advantageous. You're gonna have to possibly report that. So even if you made a lot of interest like during that year, at the end of the year you will end up paying taxes on some of your profit. So that means that you won't be able to reinvest the entire thing, because you need to put aside some money to pay for taxes, because all the interests you won't be able to keep. So you need to make sure you're putting aside something like 20% or whatever, depending on your situation, aside to be able to pay the taxes that are due at the end of the year. So that means that it has you're collecting interest, but then on the other hand, you might be have to pay taxes on those amounts. So that's one of the implication regarding taxes. So in most simpler case, it's at least they will usually provide. I mean, you will have either a report of your transaction. So either if you connect to API, you will probably see other transaction when the interest was put in your account, or you will might have to download a file with the records of all those transactions. Then you will be able to report that and calculate the taxes. So that's usually, I mean, those are pretty common in the crypto world, and they're usually relatively simple, at least to report, because most places will provide you with good records. But I still recommend that you keep track of when you made your deposit, if it's an initial or one-time deposit, and if you're doing a regular deposit of some sort. So that might be, again, another way to kind of DCA, dollar cost averaging, where you're depositing money on a regular basis. So that might allow you to benefit from the fluctuation on the value, because you might end up buying more when the value is lower. But then again, you will, as you deposit more, you probably earn more in interest again. But you need to reconcile at the end how much money you put in, and then you need to make sure that if you ever withdraw or transfer some of it You need good records, and then of course you need the record of all your interest that you collected. So that in some other probably video we might talk about more complex things like yield farming or liquidity pool. So those are more complex to understand and also to report, in fact, and often they're also in places where they don't provide necessarily the records of what you did. So you need to make sure you're keeping your own records as well. So, but that covers it for the topic of today. So thanks for being here, and if you're live or watching the replay, and if you have any question about that, or if you have any topics that you would like us to cover, let us know. And of course, now it's pretty much we're getting into tax season, as you know, in the US, at least Canada. So I think we have two more tax workshop next week as well. So if I'm going to put the link in the comments. But if you want to join one of our live workshop to learn more about crypto taxes and also some tips and tricks, and also find out more about our services. So it would be appreciated if you want to join us for those. And then, of course, we have, again, our Tuesday and Thursday tax tips on Facebook Live at 4 p.m. right now Eastern, and then on Saturday morning at 10 a.m. Eastern, we have our more like kind of strategy topic. So again, have a good evening, and we'll talk to you soon. Bye.